All right, folks. How's everybody doing today? Okay? A little chillier today. Hopefully we'll finally exit summer, or what feels like summer. Okay, so what I want to do is finish this chapter on, I think it's chapter 16 of your textbook called The Monetary System. And then next week we'll begin another topic that has to do with money as well, and its relation to some other economic variables that we've talked about in the past. And then after that, we just really have one more section on looking at some open economy macroeconomic concepts like trade deficits, trade surpluses, exchange rates, etc. And we're on pace to be able to finish before Thanksgiving. So that is looking good. Your final exam, by the way, is just going to cover the last 4 chapters of the semester. So it won't be like a comprehensive final exam in the traditional sense. It's just going to be over the chapter on the labor market and unemployment, these 2 sections on money, and then the section on the open economy macroeconomics. All right, let's go ahead and pick up then where we left off last time. So we started talking about the monetary system, and we kind of defined what money was at the start of class. It's the set of our assets that we use to purchase goods and services with, right? It facilitates our transactions. We discussed the 3 kind of classical functions or roles of money, right? Remember, it serves as a medium of exchange, as a store of value, and as a unit of account. We talked about the different forms of money in our economy, right? In particular, differences between what is a commodity money versus a fiat money. A commodity money is one that has intrinsic value, right? Meaning that if you didn't use it as a means of payment, it would have some other inherent use to you, right? Usually precious metals are thought of as the classic example of commodity monies. That's not the type of monetary system we use today, right? We are on a fiat money system where money has no intrinsic value. We only value it because the government says that we can use it to pay debts and to purchase goods and services with. We also spent a little bit of time talking about how we measure the money supply, the total quantity of money in circulation. Without getting into too many of the details, kind of the main thing I want you to take from that is this distinction between the M1 money supply and the M2 money supply, right? Which was the broader measure of money, M1 or M2? M2, right? M2 consists of everything in M1, which was all of our perfectly liquid assets, plus some other highly liquid assets like savings accounts and bank CDs and money market mutual funds and whatnot. And then I think, if I'm remembering this right, we closed class by talking about this idea of a central bank, right? In a country or within an economy that uses fiat money, there has to be some government institution that is in charge of trying to regulate the quantity of money in circulation. That institution is what we call a central bank. What's the central bank of the US called? The Fed, right? The US Federal Reserve. And then we talked a bit about the history of the Fed, when it was created, and kind of its basic structure. I think the 3 most important things there are the differences between the Board of Governors, the district banks within the Federal Reserve System, and then also the Federal Open Market Committee. Right, that is the last one is the body that actually conducts or makes monetary policy decisions in the economy. Okay, so what I would like to do today is continue on this theme of the monetary system, but switch the focus to the role of the commercial banking sector. Okay, how is it that commercial banks, private banks in our economy, can influence the total supply of money or the money supply process? Well, we'll get into this in more detail, but remember, at a kind of a base level, how do we think about money? If we want to think of it in terms of the M1 money supply, it's all of our currency in circulation, plus what? All of those checking account balances that we have at commercial banks. These are called demand deposits, all right? The latter are the biggest component of the M1 money supply. Well, clearly, the decisions that banks make in our economy are going to have at least some impact on those demand deposits, on the size of those checking account balances. And so depending on how banks behave, that can have a big influence on the economy's money supply. I want to dig into that a lot deeper today to really think about how commercial private sector banking influences the supply of money. It's not just the Federal Reserve that tries to manage the money supply, but another big player in our economy that affects its size and its composition are these commercial banks, okay? And then at the end of class, if I have some time, we're going to talk a little bit more in detail about the various tools, specific policy tools that the Fed has to try to manage the money supply. Okay, so leading into that discussion, I want to introduce some terminology that we'll be using kind of over and over again today. So I want to make sure everybody is clear with the terms before we look at the economic model. The first concept we need to understand is this thing called fractional reserve banking. That is a banking system in which banks keep only a fraction of the deposits they receive as reserves, and they use the rest of the deposits then to make loans to other investors or to other borrowers. Or perhaps they use the rest to purchase other types of assets, like stocks and bonds. Okay, now first, just to be really clear, what are reserves? Do you guys know what that is? When we talk about bank reserves, what are we talking about specifically? So when you make a deposit into your checking account, Sam, let's say you deposit $10 into your checking account, right? The bank may decide to hold 5 of those dollars in reserve and loan out the other $5 to someone else, okay? So the money that banks elect to hold instead of loan out to others is what we call bank reserves. There's 2 places that banks can hold, or there's 2 ways that banks can hold reserves. Sam, they can take your $5 and stick it into the bank vault. So vault cash is one form of reserves. But by far the biggest form of bank reserves is what commercial banks hold on their accounts with the Federal Reserve. One thing you should know is that the Fed kind of is a bank for commercial banks. Just like you guys have checking accounts with a private bank, commercial banks themselves have, in effect, a checking account with the Federal Reserve. It is called a reserve account. Most of banks' reserves are held on those overnight accounts with the Federal Reserve. Another term that we'll need to know is that the Fed establishes these things called reserve requirements. These are regulations on the minimum amount of reserves that banks must hold against their deposits. The reserve requirements have changed a little bit over time, but the Federal Reserve establishes what those reserve requirements are. That is part of their regulatory requirements, or regulatory duties, I should say. What else do I want to say here? So it's not always going to be the case that commercial banks are simply going to want to hold reserves just to meet minimum reserve requirements. In fact, almost every bank holds reserves above the minimum legal required by the Fed. Okay, the amount of reserves that banks hold over and above the minimum reserve requirements are referred to as excess reserves. I guess I don't have that term in the slides, but that's what we refer to as excess reserves. It's how many more reserves banks want to hold above the minimum legally required. One more term or concept that I will come back to several times today is this thing called the reserve ratio. This is going to be an economic quantity, so I'm going to denote it by the variable capital R. That's not an interest rate, that's the reserve ratio. So this is going to be defined as the fraction of a bank's deposits that that bank elects to hold as reserves instead of lending out to others. Okay, that's what we mean by the reserve ratio. It's the total reserves as a percentage of a bank's total deposits. Okay, does anybody have any questions about the terms then? Everybody kind of understand these? All right, so what I want to do then is examine how or in what way precisely banking activity or the decisions that private banks make affect the total money supply in our economy, okay? Now, to do that, I think the easiest way or the most useful way of examining this is to look at a bank's balance sheet. So for some of you guys who have had some exposure to accounting, you will recall that a balance sheet shows a company's or a bank's assets versus its liabilities, okay? That's what we're going to look at today. But in fact, we're going to make it simpler. I'm going to look at something called a T account, which is really a simplified accounting statement that doesn't show the full balance sheet, but really just shows the major changes in a bank's balance sheet in terms of its assets and its liabilities. To think about how banking behavior affects the money supply, it's really useful to view this activity through the lens of a T account, of a balance sheet for the banking system. Okay, so here is a super easy example, fictional example. Let's suppose that we have some bank, we'll call it First National Bank, whose T account or balance sheet looks like the following. We're going to place the assets on the left side and the bank's liabilities on the right-hand side, okay? Now, according to the T account here, First National Bank's liabilities consist of its deposits. These are deposits that customers have made at the bank, and we'll say they total $100 just to keep the math easy, okay? Now, that's my first question. Why would we want to think of deposits as being a liability for First National Bank? A liability is a debt. It's something that the bank owes someone else. So why would people's deposits at the bank be a liability for that bank? Sean? How do demand deposits work? They have to be redeemable on demand. Sean, if you write a check or you swipe a debit card or you go to the ATM and want money out of your checking account, the bank is obligated to provide you those resources on demand. So that is a liability for First National Bank. The total amount of deposits are bank liabilities, okay? Now, what about the asset side of the bank's balance sheet? According to the T account here, we have two types of assets. The reserves that the bank elects to hold, as well as the loans that it's made to other outside investors, okay? Now, or in what sense is a loan an asset for First National Bank? Well, this is money that somebody is going to have to pay back First National at some point in the future, presumably with interest, right? We're going to ignore interest payments in these little examples. So the loans that banks have provided count as assets for the banks, as well as the total amount of their reserves, right? So bank liabilities include deposits, bank assets include reserves plus loans. You'll notice on this simple T account that the sum of the bank's assets is equal to the sum of its liabilities. That always has to be true. Why? Because balance sheets have to balance, right? If bank assets fell below liabilities, then banks could come in danger of becoming insolvent. Banks need to have assets that total at least what their liabilities are. Now, let me just emphasize something really quickly. Some principal students are confused by this idea that that reserves are counted as an asset, whereas deposits are counted as a liability, right? So Sam, we'll go back to the example from earlier. When you deposit $10 into your checking account, right, that $10 is a liability for the bank. But those same 10 physical dollars, let's say First National just kept them in the form of reserves, would also be counted as an asset for the bank. So it's almost like the same money is counted both as a liability and as an asset, which can be a little bit confusing. So what I like to compare it to is kind of like a house and a mortgage, right? Sam, if you were to go out and purchase a house by taking out a mortgage, the mortgage is a liability for you. That is what you owe the bank or the mortgage provider. Although you own the house, so it is also your asset, right? And so the same physical dollars there can represent a liability for the bank, but also its assets at the same time. So try not to get confused by that. Now, in this little example, what is the reserve ratio? Matt? 10%. 10%, right? It's $10 worth of reserves divided by $100 in deposits. So the reserve ratio in this example is just 10%. Very good. Okay. So what I want to do now is work through a specific kind of numerical example of a simple banking model that can help us kind of understand or illuminate how banking decisions affect the overall supply of money, okay? So here is going to be the setup. Let's suppose that we are living in a pretend little economy, simple economy, where there is $100 of currency in circulation, okay? What I want to do is think about how the existence and the behavior of the banking system is going to affect the money supply in 3 different cases. All right, let's assume in the first easy case, and this is just going to be the comparison case, that there's no banking system whatsoever. Okay, what is the money supply for that particular economy? Let's compare that then to a case in which there exists a banking system or a bank, and that bank practices what's called 100% reserve banking. So every dollar in deposits at that bank is held in the form of reserves. There are no loans made to outside investors. And then the third case we want to be the most interesting case here is going to be fractional reserve banking. That's the case that reflects reality, right? In the real world, of course, banks practice fractional reserve banking. But I want to go through the first 2 cases quickly because this is how we use an economic model, right? If we want to tease out the effect of how bank behavior affects the money supply, we should compare the case of fractional reserve banking to the cases in which a bank doesn't exist or a bank practices 100% reserve banking. Okay, any questions then about how we're going to proceed with that? All right, so this should be pretty straightforward. Let's look at the first case really quickly. This is the case in which there is no banking system whatsoever, okay? So what is the money supply going to be in this pretend silly little economy where we have $100 worth of currency floating around in circulation? The money supply is going to be just $100. If we think of the money supply as simply being the sum of currency plus deposits at banks, if there's no banking system, then the money supply is just equal to currency, okay? Now, let's compare that case in which no one interacts with a banking system at all to the second case in which we have banks, but they practice what's called 100% reserve banking, right? So let's assume then that some pretend bank, we'll just call it First National Bank, is created purely as a depository institution here, okay? That is a place where people in our model can go to deposit their currency, and the bank is going to hold all of those deposits in the form of reserves. So you can either write a check or use a debit card to make transactions, and money will be moved around by the bank exclusively, okay? There are never going to be any loans then made to other banks or other investors in the economy, okay? So in this case, let's just assume for to make this as easy as possible, that everyone in our little economy here takes whatever amount of currency we have, and we set up our checking account, and we dump all of those funds into First National Bank. If we want to think about how 100% reserve banking affects the money supply, again, it's easiest to do that by analyzing the bank's T account, okay? So what happens here? If all of us go to First National Bank and deposit our currency, then the total liabilities of First National is going to be $100 worth of deposits in the economy. And because First National practices 100% reserve banking, they choose to hold every dollar of those deposits in the form of reserves and $0 in the form of loans, right? So assets will be equal to liabilities in this case. Okay, now that's what happens. What happens to the money supply as a result of this? Again, what is the money supply in this simple little world? It's the amount of currency that is held by the non-bank public or private sector, plus the amount of demand deposits that are held in the economy. So before the creation of First National, the money supply was what? $100 worth of currency and 0 deposits. So the money supply was just $100. What is the money supply now after everyone deposits currency into First National Bank? Well, the money supply is going to be $0 in currency, but we've now got $100 worth of deposits, right? Remember, currency, as it counts towards the money supply, only counts if it's in the hands of the non-bank public. If it's in the bank vault, it's not part of the money supply, right? So what has happened to the money supply here? In a 100% reserve banking system, the money supply doesn't change. Banks don't affect the overall size of the money supply. And I think that's pretty obvious. But what have they affected? Banks are going to affect not the size of the money supply, but the composition of the money supply, right? The money supply used to be all currency and no deposits. And now with 100% reserve banking, money is all deposits and no currency. So whereas the size of the money supply is not affected, the composition of the money supply is going to be affected. Okay, questions about cases 1 or 2. Those are super easy. Let's move on to case 3. So this is the case that's going to reflect real world conditions a little bit better, okay? All right, it is highly unlikely that First National Bank is going to need to hold all $100 of these deposits in the form of reserves, right? And why is that? Why are most banks not going to need to hold 100% of their deposits in the form of reserves? Matt? Yeah. It's very unlikely that everybody is going to want to withdraw their money at one time, okay? And so that means that banks can have an opportunity here to loan out a portion of those reserves and only hold a small portion to meet those kind of withdrawal demands. Almost every bank that I know of behaves in this way. That is, they practice what's called fractional reserve banking, not 100% reserve banking, okay? Let's assume here, again, to keep the math as simple and as straightforward as possible, that First National Bank elects to choose a reserve ratio of 10%, okay? So for every $10 that are deposited, they're going to hold $1 in reserves and loan out the rest. How does that particular decision by First National, affect the money supply? The simple decision to practice 10% reserve banking here is immediately going to have an impact on the money supply. And we can see that by analyzing, again, the T account of First National Bank. So here, Matt, you deposited your $100 into First National. Instantly, their reserve account goes up by $100. But First National decides to only keep 10% in the form of reserves. And what does it do? It loans out the other $90, okay? So now, what is the money supply equal to? Before First National made this decision, the money supply was $100 worth of deposits. Now, what is the economy's money supply equal to? It should be equal to currency plus deposits, right? Well, what are deposits? They're still $100, right? First National, Matt, owes you $100 on demand if you want to withdraw it. But now First National has loaned out $90 worth of currency, let's say, to other people in the economy. And so the total supply of money then has gone up exactly $90. So this simple decision by First National to only hold a fraction of its deposits in the form of reserves has an immediate kind of impact, increasing effect on the money supply. And in this example, it increases the money supply by $90 exactly. Now, let me stay on this particular example for a few more minutes because I want you guys to understand exactly how the money supply increases in this case. Sometimes it's kind of confusing to principal students because economists will oftentimes use the phrase, banks can create money. Well, that can be confusing because banks aren't literally printing dollars, right? Most people think creating money is like printing dollars. That's not what banks are doing, right? The government is the institution that literally prints dollars. But yet banking activity can create money because money is not just green currency, right? It also includes demand deposits, all right? How did the money supply grow in this case? The very second that the bank decided to make a loan, they were providing currency to that borrower, right? That currency is an asset that gets counted towards the money supply. But at the same time, the bank's deposit obligations haven't changed at all. So currency in the hands of the non-bank public has gone up. Deposits have not changed, and therefore the total supply of money has gone up as well. That's the sense in which banks are creating money. This process of creating new loans raises the amount of currency held by the non-bank public and therefore increases the money supply. Now, one thing I do want to emphasize here is that even though banks can quote unquote create money, they don't actually create wealth, okay? Do you guys remember how we defined wealth in the last class? This is the total value of our assets minus our liabilities or our debts, right? So think about it. When First National provides a new loan to someone in the amount of $90, that increases the money supply by 90, but that also is a debt that the borrower now takes on. And so that increases the total liabilities in our economy by $90. And so the money supply rises by 90, but new debt increases by 90. And so there's no change in wealth. So be careful about that. Banks can create money by practicing fractional reserve banking, but they actually can't increase wealth because every time they make a loan, they also increase public debt. Okay, you guys have any questions about that? Let me continue on this example then. Do you think that the creation of money is going to suddenly stop after First National Bank has made this single transaction? Not likely, right? What is typically going to happen here is that whoever borrows that $90 is going to spend it on goods and services. And the sellers in those transactions will ultimately deposit those $90 back into the banking system, okay? So there's going to be another round here of how banking decisions can affect the money supply, all right? Let's suppose here that the borrower from First National ends up depositing the funds at a second bank in our economy. We'll call it Second National Bank to keep the theme going here. And we'll also assume that Second National Bank, just like First, is going to practice 10% reserve banking. Okay, well, again, keep the math as easy and as straightforward as possible in this example. So when these $90 get spent and then ultimately get deposited back into another bank, the liabilities at Second National Bank raise by $90, right? And their assets go up by exactly $90 as well, because this bank has now received 90 bucks in new reserves. All right. So the money supply right now is equal to what? It's $100 worth of deposits at First National Bank, and it's 90 bucks worth of deposits at Second National Bank. Now, if Second National decides to make a loan to another investor, what happens to the money supply? If they hold 10% of their reserves, of their deposits in the form of reserves, then they're going to lower their reserves down to $9 and loan out the other 81. Okay, and so now what has happened to the money supply? The money supply has gone up again by an additional $81, right? So instead of $190, we have what? $271 in money. That's 100 bucks in deposits at First National, 90 bucks in deposit at Second National, and then $81 of new currency. So simply by virtue of another bank practicing fractional reserve banking, we have a new loan created, a new deposit created, and the money supply is going to go up again. Again, we can continue with this exercise. What if this $81 that was loaned out to an investor got spent in the economy and then redeposited back into the banking system, and let's say we'll call it Third National Bank? How does this affect the money supply? Again, look at the T account. If Third National Bank practices 10% reserve banking, then that $81 deposit at Third National Bank is going to result in $8.10 of new reserves at Third National, and therefore $72.90 of additional brand new loans to an outside investor. Again, assuming Third National practices 10% reserve banking, just like all the other ones did. I'm going to make that assumption throughout just so the math is as easy as possible. So now what's the money supply? Well, there's 100 bucks in deposits at First National, plus 90 at Second National, plus 81 in deposits at Third National. That's $271. But now there's an additional $72.90 in currency in the non-bank public. That brings the money supply to around $344. Again, every time a bank takes a deposit, holds a fraction in reserves, and loans out the rest, this multiple loan deposit expansion process increases the money supply. So it's not just the Federal Reserve that determines what the money supply is. The banking system also has a large effect on the money supply. Now, let me ask you kind of a theoretical question here. In principle, we could do this exercise forever. I'm not going to do that though, right? We could look at a fourth bank and a fifth bank, etc. We could take that on out to infinity. So does that mean that this original deposit of $100 is going to create an infinite amount of money? Not likely, right? What is going to happen is that this loan deposit expansion process is going to continue, but eventually it's going to stall out at some point, okay? Now I'll just tell you, and I'm going to do a little Excel exercise here in just a minute to try to illustrate this a little bit more clearly. But if we were to do this exercise many, many times, what we would find is that this original deposit of $100, which generates lending at First National of 90 bucks, lending at Second National of 81, lending at Third National of 72.90, and on and on and on and on, ends up creating $1,000 worth of total new deposits in the economy. And so that $100 initial deposit at First National Bank expands the money supply in our economy by exactly $1,000. Okay. Now, what is the intuition here? Because this is something that I want you guys to be able to grasp. In this example, the money supply is going to keep expanding through multiple loan deposit creation until something happens. That something is that every single dollar of the original deposit into First National Bank gets absorbed into the banking sector in the form of reserves, right? Think about this. How much did First National keep in the form of reserves? $10 of that original $100 deposit. How much did Second National keep in the form of reserves? $8.10. Third National kept $7.29. Eventually, all $100 of the original deposit is going to find its way into the reserves of the banking system. When that happens, multiple deposit loan expansion is going to cease, and that's going to tell us what the total supply of money is, or the change in the total supply of money. So I've got let me illustrate this. I've got a little Excel file here that illustrates exactly what I'm talking about. So up here in the first couple of rows, I've got the original deposit of 100 and the reserve ratio of 10% in this example, okay? These rows here basically replicate what is in the slides. And what's here on row 4 shows the cumulative total deposits, total reserves, and total loans. Now watch what happens if we continue the process that I described in class today for a long time. I'm going to highlight these cells and copy the formulas down. What do you see happening here? Eventually, you see that the deposits at each bank and the reserves decline over each of these iterations, and it converges to some point. And it's the point at which total reserves increase by $100 and matches the original deposit. When that occurs, once every dollar of the original deposit is being held in the form of bank reserves, total deposits will stop expanding. And in this example, it was equal to $1,000. Okay, now obviously on your exam, I'm not going to let you use Excel, okay? But fortunately, there is a simple formula that you can use to determine how much a given increase in reserves is going to affect the total amount of new deposits in the economy. It's called the money multiplier, okay? Sometimes it's referred to as the simple deposit multiplier. Again, it's the amount of money that the banking system generates with each additional dollar of reserves, okay? The money multiplier, maybe you guys already recognize this, is simply equal to 1 divided by the reserve ratio. In our example today, the reserve ratio is 10% or 0.1. And so the money multiplier is 1 divided by 0.1, which is just equal to 10, okay? And so that means that $100 of new reserves in the banking system will ultimately create $1,000 of new money. Through the process of multiple deposit loan creation, the banking system, via fractional reserve banking, can expand the total money supply by $1,000 given a $100 increase in bank reserves. What happens to the money multiplier if the reserve ratio goes up So let's say now that banks are electing to hold 20% in the form of reserves instead of 10%. What do you think happens to the money multiplier? John? It's going to go down, right? If banks are holding more in reserve, that means they're lending less to investors. The less dollars they lend, the less money is going to be created, right? And so the higher the reserve ratio, the lower the money multiplier. If banks reduced their reserve ratio, exactly the opposite would happen. They would loan out more to investors. More money would then get redeposited into the banking system, which would create even more loans, et cetera, et cetera. So the reserve ratio is inversely related to the money multiplier. Okay, let's do this problem, or let me give you actually a minute to work on this problem to kind of test your understanding of this concept in a different application here. So while cleaning your apartment, you look under the sofa cushion and you find a $50 bill. You deposit that bill into your checking account, okay? I want you guys to assume that the Fed's reserve requirement is 20% of deposits, okay? And that banks here are, well, let me just ask this. What is the maximum amount then that the money supply could increase? If the minimum reserve requirement is 20%, what is the maximum amount then that the overall money supply could go up by if you deposit this $50 bill in your checking account? And then part B, what is the minimum amount that the money supply could go up by? How would we figure out what the maximum amount that the money supply could go up by? Let's apply the money multiplier, right? In this case, what's the money multiplier going to be equal to? If the reserve ratio is 20%, what's the money multiplier? Matt? It's 5, right? So if banks are holding no excess reserves and they're lending out the maximum possible, the money multiplier here is 1 over R, so that's 1 over 0.2 is 5. And so, Matt, if you deposit $50 that you found under your sofa into the bank, then that's going to increase total deposits in the economy a maximum amount of $250. The money multiplier 5 times the amount that you originally deposited. Okay, now, what is the question asking though? What is the maximum amount that the money supply could increase by? It's not quite $250. It's a little less than that. Why, Matt? That's right. So remember, Matt's $50 that he found under the sofa cushion was part of the money supply. Even though he didn't know it was there, it was still currency in circulation. If he deposits that into a bank and those $50 eventually find their way into the form of bank reserves, then the total change in the money supply is the change in currency plus the change in total deposits, which would be minus 50 plus 250. And so the maximum increase in the total money supply then is going to be $200. Be careful about that, right? If you take currency and you deposit it into the bank, it can expand the money supply through multiple deposit expansion. But it's going to have a negative effect on the money supply because that lowers currency in circulation. The net effect here is plus 200. Okay? What is the minimum that the money supply could increase by? Sean? 0, right? And how would that happen? If Matt's bank here simply keeps all $50 in the form of reserves, then currency falls by 50, but demand deposits rise by only 50 instead of 250. And so the total change in the money supply would just be 0 here. So the effect of this particular action on the money supply is going to be somewhere between 0 and $250, depending on the different decisions that are made. Okay. You guys have any questions about that? Okay, so um, that is that's what I mainly wanted to accomplish today, was to discuss how um, the banking system, through the practice of fractional reserve banking, can affect the money supply. And it is summarized by this idea of the money multiplier, or the simple deposit multiplier. Make sure you guys understand kind of where that comes from and how you can apply it in different situations. Let me finish the class today by spending some time talking about how the Federal Reserve can impact or try to manage the amount of money in circulation. That is, what tools does the Fed have to try to control the money supply? There's several of them that I want to actually spend a little bit of time talking about here today. To build on this, it's important to, I guess, to recognize here that kind of the main thing that we discovered today was that the total money supply, or the increase in the total money supply, is essentially the money multiplier times the number of new bank reserves that were created. Okay. So if we want to think about how the Federal Reserve or any central bank can impact the total money supply, then it's important to understand that the Fed can take various actions that affect either the quantity of bank reserves in the economy or the money multiplier directly. Right? The Fed is charged with trying to manage the supply of money. But the Fed doesn't have perfect control over the money supply. Why? Because of all of this private banking behavior. And so when the Fed is thinking about how it wants to conduct monetary policy, it has to consider how its actions will work their way through the banking system. The various tools that the Fed has can affect either the money multiplier or the quantity of bank reserves directly. All right. So I'm going to spend a few minutes now talking about 4 or 5 different policy tools that the Federal Reserve has at its disposal that can affect the money supply in one of these 2 ways, either by affecting bank reserves directly or by impacting the money multiplier. The first one I want to talk about is probably the most important, and that is what's referred to as an open market operation. So this is a policy tool that the Fed uses from time to time to affect the total amount of reserves in the banking system. Now, let me define formally what an open market operation is, and then I'll try to kind of describe a little bit more intuitively how they work, okay? This is, by the way, this is kind of a complicated concept, and open market operations are discussed in detail if you go on to take higher level macroeconomics classes. But I do want to provide at least some intuitive understanding of what these things are, because they're very important to the Federal Reserve. Okay, an open market operation is essentially the purchase or the sale of US government bonds by the Federal Reserve. Now, the Fed isn't buying these bonds directly from the US government, but rather it's buying bonds and selling bonds to counterparties that are in the private sector, like commercial banks and other types of securities dealers. When the Fed conducts those transactions, it's engaged in what's called an open market operation. Okay, now, how does an open market operation affect the amount of bank reserves in our economy and therefore the money supply? Well, I think it's easy to think about here that imagine the whole private sector, so private citizens as well as commercial banks, have some kind of collective portfolio of money and bonds, right? All of us together own some amount of government bonds, and we also have some amount of money, okay? If the Fed wants to increase the money supply, one thing that it can do is that it can buy bonds directly from the private sector. All right? If the Fed buys bonds directly from the private sector, then think about what happens here. The Fed takes ownership of those bonds, okay? And how does the Fed actually pay for them? By injecting new money into the private sector, or more often than not, by injecting new bank reserves into the banking system. So what happens in this situation is that the private sector's portfolio then of money and bonds becomes more heavily tilted towards money and less in bonds. That's how the Fed normally expands the money supply, by conducting an open market purchase of government bonds directly from the private sector. That shrinks our holdings of government bonds, but expands our holdings of actual money. Now, if the Fed wants to shrink the money supply, it does exactly the opposite, right? Instead, it sells government bonds from its balance sheet to the private sector. Now, if the Fed sold government bonds to the private sector, then how does the private sector pay for those bonds? By drawing down their supply of money, or by drawing down their demand balance accounts at commercial banks, for instance. So when the Fed sells government bonds, the money supply shrinks, right? If the Fed buys government bonds, the money supply expands. And it does so by affecting the amount of reserves in the banking system directly. I think that's probably the most important and most frequently used tool that the Fed has to impact the total money supply. It is not the only one, though. So another way that the Fed can impact the quantity of reserves in the banking system is by making loans directly to banks, okay? Now, why would the Fed ever make a loan to a private commercial bank? Well, I can think of probably 3 reasons, okay? Sometimes banks are experiencing a lot of withdrawals and they need an emergency loan from the Fed. Sometimes banks need to meet their minimum reserve requirements, okay? And so they have to take out a loan from the Fed. Other times, the banks might want to simply borrow from the Fed so that they can make loans to other investors. Whatever the case may be, one way that the Fed can increase reserves in the banking system is simply by making direct loans to banks. Now, there's 2 ways that the Fed can do this. The traditional method of making loans to banks is through something called the discount window. Okay, so let's suppose that one of our local banks, like Regions Bank or Alabama Credit Union, needed to take out a loan from the Fed. What it would do is it would go to the District Federal Reserve Bank of Atlanta to try to access that loan. And it does so through something called the discount window, okay? The interest rate that the Fed charges banks on loans from the Fed is called the discount rate, all right? That's the interest rate that the Fed charges on those loans directly to banks. Now let's think about this for a second. If the Fed decided to increase the discount rate, then banks are most likely going to be discouraged from taking out loans from the Fed, right? If the interest rate is higher, if the cost of borrowing from the Fed goes up, banks are going to want to borrow fewer loans from the Fed. So bank reserves would decline and the money supply would decline. If instead the Fed wanted to try to expand the money supply, it could do the exact opposite. Lower the discount rate that it charges, and that would encourage banks to try to borrow from the Fed, expand bank reserves, and therefore expand the money supply through this multiple deposit creation process that we've talked about today. The second method that banks can borrow directly from the Fed, however, is something new called the term auction facility. I'm kind of compelled to talk about this because it's something that has happened and continues to happen since the financial crisis of 2008 and 2009. So let me kind of explain how this works. Under the term auction facility, the Fed actually chooses the quantity of reserves that it's going to loan to banks. And then eligible banks, what they will do is they will compete with one another for those loans in a competitive auction bidding process. And the bank or the set of banks that agrees to pay the highest interest rate is the one that wins the loan from the Fed. So this is an alternative facility that banks have to borrow directly from the Fed. Really, if you think about it, the main difference between the term auction facility and the discount window is that in the discount window, banks are deciding how much they want to borrow, but the interest rate on those loans is set by the Fed. In the term auction facility, it's exactly the opposite. The Fed is determining how much it wants to loan, but the interest rate on that loan is really determined by banks in this competitive bidding process. So they're both ways in which the Fed can make loans to banks, but in one, the interest rate is set by the Fed. In the others, the interest rate is determined by banks. So that's really the key way in which they are different. Okay, so we've talked now about a couple of ways in which the Fed can influence the quantity of reserves in the banking system. The Fed also has a few other tools that it can use to impact the money multiplier directly, and therefore the money supply. So I think it's important that we go through these two. All right, now recall what the money multiplier is. The money multiplier, again, is 1 divided by the reserve ratio, right? Reserve ratio is reserves to deposits. So if the Federal Reserve can do something to impact the reserve ratio, then it will change the money multiplier and therefore will have an impact on the money supply. Well, there are 2 things at least that the Fed can do that affects the reserve ratio. One obvious one is changing reserve requirements. Again, these are the regulations on the minimum amount of reserves that banks have to hold against deposits. What happens if the Fed lowers reserve requirements? What happens to the reserve ratio? Reserve ratio goes down, and therefore what happens to the money multiplier? The simple deposit multiplier goes up, which expands the money supply. So another way that the Fed can expand the money supply is by lowering reserve requirement, right? It can do open market purchases of bonds. That raises the money supply. It can lower the discount rate or increase these term auction facility loans. But another thing it can do to raise the money supply is lower the reserve requirements. That lowers the reserve ratio and increases the money multiplier. If instead it wanted to reduce the money supply, it does exactly the opposite, right? It could increase reserve requirements, which would raise banks' reserve ratios and therefore shrink the money multiplier. That's the 4th policy tool that the Fed has to affect the money supply. Let me talk about one more. And again, I'm compelled to discuss this one because it's gotten increasingly important since the financial crisis. In the last generation, when principal students got to this part of the class, they really only had to talk about open market operations and reserve requirements, okay? But since the financial crisis, the Fed has kind of invented all new means of trying to change the money supply. And so I think it's important to discuss some of the new and innovative techniques that they are using. Here's another one. Since October of 2008, the Fed has actually paid interest on reserves that banks keep in their accounts with the Fed. Now that's a little odd, right? When you guys have a checking account with a bank, normally the bank is not going to give you any interest on those checking account balances, right? Well, the checking account balances that banks have with the Federal Reserve used to pay 0 interest. But ever since October of 2008, the Fed has actually paid some interest on them. Now, right now, the interest on those reserve balances is really low. It's like 0.25% and on an annual basis. But just a couple of years ago, it reached as high as about 2.5%. Okay, so they're not insignificant. Now, let me throw this question to you. What do you think would happen to the money supply in the economy if the Fed increased the interest that it pays banks on reserves? Sean? Why? Perfect, right? If the Fed offers a higher interest rate on reserves, that's going to encourage banks to hold more excess reserves and loan out less to investors and to purchase other assets with, right? And so there's less deposit loan creation, and therefore the money supply shrinks. Or more formally, a higher interest on reserves would raise the reserve ratio and therefore shrink the money multiplier. If the Fed instead was really concerned with expanding the money supply, it would want to do the opposite, lower interest on reserves. That should provide more of an incentive for banks to loan out their reserves than park them overnight in their reserve checking account with the Fed, okay? A lower interest on reserves would reduce the reserve ratio, would therefore increase the money multiplier, and therefore increase the money supply. Very good. Okay. Now, I know that may seem a lot, but again, let me kind of just summarize what we've talked here with regard to the Federal Reserve. There's 2 ways that the Fed can impact the money supply: by doing things that affect bank reserves directly, or by trying to change the money multiplier. What can they do that affects bank reserves directly? Engage in open market operation or lend directly to banks, either through the discount window or the term auction facility. The Fed can also influence the money multiplier through the reserve ratio in 2 ways: by changing reserve requirements and also by paying interest on reserves. Those 2 things have an effect on the reserve ratio and therefore the money multiplier. Okay, the last thing I want to say here is I don't want you guys to get the idea that even though the Federal Reserve has all of these fancy tools at its disposal to try to manage the money supply, that it actually has perfect control over the money supply. It does not, okay? The Fed can try to manage the money supply or regulate it, but it does not have perfect control over the money supply. And there are really 2 main reasons why it does not, okay? First of all, the Fed does not or cannot perfectly predict how the private sector is going to allocate its money between currency and demand deposits, right? You guys may not make this decision consciously every single month, but you make what's called a portfolio decision. You've got some amount of money and you decide how much of it you're going to hold in cash and how much of it you're going to keep in your checking account balance. Okay? When economic conditions change, that decision may change, right? If, for instance, Matt, if you thought that the banking system was in danger, then you might want to withdraw more of your money from banks and hold it in the form of cash. Well, what does that do to multiple deposit loan creation? If we hold more of our money in currency and less in demand deposits, that is going to shrink the money multiplier and shrink the money supply, right? The Fed cannot perfectly predict how we're going to make that decision between currency and checking account balances, right? And so that's one reason why the Fed doesn't have perfect control over the money supply. Another and perhaps more important reason is that the Fed also cannot predict with 100% accuracy how banks are going to allocate their assets between reserves and loans. In these little Mickey Mouse examples that we did today, we just assumed that banks only held the minimum required reserves, that excess reserves were zero. But what if banks thought that economic conditions were weakening and they elected to hold a lot more in excess reserves? Then the money multiplier goes down, and therefore the money supply goes down. So the Fed does not know perfectly how banks are going to allocate their assets between reserves versus loans, right? Some banks may want to hold a lot more excess reserves. Others might want to hold only the minimum required reserve. The Fed has to think about how the banking system and how the private sector is going to behave and make decisions regarding those things when it wants to try to control the money supply. Now, I will say that the Fed can try to compensate for all of this behavior, and I should probably reword this. I don't think the Fed has really precise control of the money supply, but it can do its best to try to manage it by making predictions about how the household sector and the banking sector is going to behave. But the main point here is that it's incorrect to think that the Fed has perfect control over the money supply. They don't, because the money supply depends on the actions, not just of the Fed, but also of the banking system, as well as private households. Okay, you guys have any questions then about that? So the two kind of main learning objectives for today is, one, this idea of simple deposit creation and the money multiplier. And then the other are the various policy tools that the Fed has to try to regulate the money supply. We talked about 5 of them. So make sure you guys kind of know the differences between those and how to apply the money multiplier formula in some of these simple type problems, okay? All of that was to illustrate, again, how the banking system, in concert with the private sector and the Fed, can impact the money supply. If there's no questions, that is all I have, and I will see you guys next week.